Matthias Muehlbaur. I'm the co-founder and COO of OnePointFive. And really excited to be speaking alongside Chris here and also Nina on this webinar. A little bit about my background. I've actually got a bit of a villain past and origin story. I started my career at PwC, initially in auditing, moved into consulting in M&A strategy, worked a lot in the sort of oil and gas and mining and energy part of the Australian economy, which is par of the course for Australia as a high commodity export country. Ended up moving over to the US after doing my MBA, and have been building OnePointFive for the past 5 years or so, based in New York. We've done around 120 plus net zero and sustainability projects, including some projects on the upcoming Californian regulations. And so I'm bringing in some of that insight and expertise from those experiences as well. A little bit about what we do at OnePointFive. We're really set up to address capacity constraints of ESG and climate teams, helping these teams navigate changes. As this webinar shows, there's a new regulation and a shift and change in how organizations need to react and adapt every other day. At the same time, these teams are often lacking limited sort of expertise, and it's incredibly difficult to make the right decisions. There's so many different climate solutions out there. Which ones are actually the ones you should use? Which ones do you need to ignore? Our model brings in our 1.5 Academy and our rich content library, as well as our advisory side of the business, where we leverage business and sustainability at the same time to provide future-proofing opportunities to organizations. Let's jump into the discussion around California regulations and compliance as well. You might be wondering, off the heels of Climate Week in New York, what is actually happening in the space of sustainability? We've heard headlines like sustainability and ESG is dead. We've talked about the net zero recession. This is from a report that Bain's put together, covering a lot of publicly available surveys of CEOs. And we see that in 2018, most CEO comments focused on sort of compliance and doing good for society. But as we went through the early 2020s, we saw this ramp up in terms of this focus around CEOs and sustainability. We've seen the bottom of this trough in 2024, and we're seeing a tick up here according to this survey as well. And if you actually zoom out, we can see that environmental risks do remain in the top 10. This is from the World Economic Forum and their 2025 Global Risks Report. And you can see in green, the next 10 years, environmental risks are really, really important here. Out of the top 10, we have 5 positions of that top 10 ranking. However, what we're also seeing is that when organizations are asked about what's actually happening on deck at the moment, climate risks are materially impacting these activities now. So regardless of this CEO attention and what's on the agenda, climate is really the trend that continues to place pressure on business activity with consequences. In this Morgan Stanley Institute for Sustainable Investing Signals report, we see that more than half of respondents have seen increased operational costs. 40% globally have had disruptions to the workforce. 39% have had revenue loss due to business interruptions or supply chain failures. 35% have had shifts in customer and client demand. We also see that 3 of the top 4 sustainability challenges companies face in the next 5 years relate to cost, which is certainly concerning given high interest rates and shifting policy, reducing federal funding to support decarbonization, specifically in the US. And so reporting is incredibly important as these shifts and changes happen in the background. And so reporting on the ongoing climate impacts to your business is a fundamental part of showcasing what you're doing to adapt to climate impacts in your business as well. At the same time, CFO's perception of the business case can actually hinder some of this progress as well. Despite most CFOs across geographies seeing a clear business case for investing in sustainability, they largely see it as a cost decision. 93% of CFOs see a clear business case for investing in sustainability. 69% of CFOs expect a higher ROI from sustainability initiatives compared with conventional investments, which is a bit of a double standard here. And 61% of CFOs see sustainability investments primarily as a cost center and decision rather than something that can create value as well. And so when we do look at reporting, unfortunately, what we're seeing is that this is seen as a compliance and cost center within an organization. If we take a step back, reporting is not a silver bullet, but it builds the foundation. And we're going to be talking about some of these must-do tactics with these pending deadlines coming through for SB 253 and 261 as well. But we are seeing that as of 2022, from the chart you see on the right, 96% of the 250 largest companies with the largest revenue are actually reporting on sustainability. And while this shows that big players are taking climate seriously, the impacts of this still remain to be seen. We haven't yet seen CO2 emissions reducing in a proportional manner since this uptick in reporting. And a lot of this reporting has also been largely voluntary. And so we are seeing a gap between this reporting side of things as well as the decarbonization impact of that activity. Nevertheless, when you do look at the impact of regulations and the California regulations that we'll talk about in a second are part of this, we do see that regulation does limit unregulated CO2 rise. This study is from Nature Climate Change and showcases what happens when you do have regulation versus not. We see between 1999 and 2016, climate laws did reduce aggregate CO2 emissions by 38 gigatons of CO2. And this roughly equates to 5 to 9% of the carbon budget. Now, what we are seeing is this leaders versus laggards approach to how we're using standards and frameworks. But what's interesting is that we have these regional compliance regimes like the California are part of California's historic climate-related financial risk legislation. And of course, we've seen the EU post the EU omnibus proposal or the rollback, about 6,000 companies that are located in the EU or foreign companies doing business in the EU are covered by the Corporate Sustainability Reporting Directive. So that gives a little bit of a landscape so we can understand a bit of the context. So where does the California regulations SB 261 and SB 253 come in? Well, as you can see these side by side, the California regulations beside CSRD and IFRS S1 and S2, laws from the Californian regulations SB 261, 253 require businesses to disclose their GHG emissions, and this is for 253, and their climate-related risks and strategies, SB 261. This applies for companies that are either over $1 billion in revenue, this scopes them in for 253, or over 500 million, and this is for 261 as well. Now, if we take a look at what actually is required here on 253, we see that scope 1, 2, and 3 is required if you meet that threshold of over $1 billion. Compliance dates are fast approaching. We have roughly about 13 weeks left to go, and the penalties for this are up to $500,000 per year. On the 261 side, looking at climate-related financial risk, this relates to disclosing your climate-related risks, your opportunities, and your metrics assessment. This also includes the inclusion of TCFD, which covers governance, strategy, risk, and metrics and targets. Now, this is actually a biannual requirement here, but the deadline is still coming up in 13 weeks on January 1st, 2026. Now, the penalty for this is up to $50,000 per year. Now, in terms of what the California Air Resources Board, or CARB, is saying, the guidance, unfortunately, is still being finalized. And this has been a bit of a sticking point for companies that are trying to navigate, to invest, and get resources around the disclosure work that's required. Having said that, we have initial reporting deadline coming in 13 weeks or so. So what they have stipulated is that good faith efforts will be penalized. Sorry, good faith efforts will not be penalized, to make that clear. And what this means is that you need to have an attempt at addressing your climate risk or your emissions measurement activities as part of these efforts too. And we're going to share a little bit about what this could look like. Essentially, you're needing to use a lot of these existing frameworks. For example, for 261, you're leveraging what's already out there for the Task Force of Climate-Related Financial Disclosures around governance, strategy, risk, and metrics and targets. On your emissions measurements, you need to be using the GHG protocol, and you need to be measuring scope 1, 2, and 3 as well. From here, you might be thinking, when I'm just reporting, it is a cost center. How does it actually connect to my business? Well, a good example here is looking into 261. It actually uses the TCFD framework, which highlights your key risks, which you can see on the left-hand side of the screen here. Transition risks and physical risks. Transition risk being your shifts in policy that are going to impact your business, the shifts in technology, in markets, and potential reputations. On the physical risk side, this looks at climate hazards, right, in both acute and chronic situations. Acute can be natural disasters, for example. Chronic can be the longer tail impact of, say, extreme heat, extreme weather on your business. On the opportunity side, this highlights areas like resource efficiency, looking at additional energy sources or alternate energy sources, looking at low carbon opportunities for your products and services, looking at additional markets you can access, and also understanding how you can make your organization more resilient. And so you can see the risks on the left-hand side and the opportunities connecting in with the TCFD framework, where you need to start strategic planning, you need to look at your risk management and your financial impact. And this then flows down into the key business areas that people are likely familiar with if they're working in a business, namely the income statement, the cash flow statement, and the balance sheet as well. And this is where you can drive your revenues and expenses, as well as your assets, liabilities, and capital and financing. So what we're seeing is that for SB 261 and 253, you need to first protect your license to operate, and this will allow you to create value beyond reporting. When you look at protecting your license to operate, this is really helping to manage your regulatory pressure that you have from the various standards out there, in this case, California, but that could expand if you expand your operations into the EU or jurisdictions where ISSB is mandated. On top of that, you can preempt things like greenwashing litigation and protect your protect your reputation through being transparent and also meet your investor and stakeholder demands. And this enables you to create value. You can differentiate your products, your services in the market through things like lower carbon alternatives, resilient supply chains. You can make sure that your customer is always receiving your products because you've been able to set up resilient supply chains. You're also catalyzing cross-functional initiatives across your organization, which is helping with people work together, understand new ways of understanding their climate risk data, their climate opportunity data as well, which can drive strategic value. You're also able to access cheaper capital through this transparency, and you can also retain your employees as well, as you're a values-led organization. Now, reporting is not a silver bullet, as I said. There is a disconnect between reporting and execution. The majority of FTSE 100 companies they surveyed in 2022 have actually published plans that don't yet address key questions on strategy and execution around their climate transition. Only 5% of FTSE 100 companies have published their net zero transition plans, despite 80% of them reporting. And so there's two messages that I want to leave with you. Reporting alone doesn't decarbonize. It's the people that do. However, reporting does drive accountability, and accountability drives actions. Now, you're in a time crunch, a bit of a cheat sheet here of what you can look at. If you are in threshold for SB 261, you're probably less sophisticated with a lower revenue amounts. You probably have limited resources. Focus on your governance and risk management, and focus on your data capabilities and availability today. You probably have a set of governance structures and management that has some element of climate expertise. You probably have some existing risk management systems that can be uplifted to include climate risks, for example. Build an implementation plan based on some of these gaps that you identify. And then on the data capabilities and availability side, assess the sophistication of your data collection needed. Do you have 50,000 entities? Do you have 500? Do you have 10? The amount of sophistication required will mean that your data collection needs to be not on a spreadsheet and simplified in a way that allows you to address the 3 months that we have until Jan 1st. On top of that, you need to provide some standardized communications and potentially a reporting test sheet to make sure that all your team members that are helping with that data collection process get buy-in, understand what you're doing, and that can address any bottlenecks. On top of that, review your data availability for your energy bills, utility bills, your building facilities as well, and avoid these data collection bottlenecks where we see a huge amount of time wasted. I'm going to pass this over to Chris, who's going to go a little bit into that last topic there and much more. I'll pass it over to Chris.
Yeah, thanks, Matthias. Appreciate it. I guess I can sort of take over the sharing here.
Yeah.
One quick comment from my end. If anyone has questions, feel free to write them down in chat and we'll cover them at the end. So if there's anything that you want to ask Matthias afterwards, feel free to write it in the chat, and same for Chris, and then we will cover everything at the end.
Are we back in terms of slides?
Yeah, we're back.
Terrific.
We're so back. Yeah.
We're so back. I love it. Yeah, so I think as Matthias mentioned, and I think as most people are already familiar, we at Brightest are really kind of specialists in terms of sustainability data. So we work a lot with AI, but generally we are supporting and working with organizations and kind of providing expertise across, software, reporting, again, a lot of the different workflows that Matthias was mentioning, like data collection, data analysis, and other things, both in kind of the climate risk domain, sustainability, ESG, and sort of everywhere in between. And we've been kind of working with various different clients, both existing clients and newer clients, for the majority of the year. And a lot of our larger clients, particularly ones doing business in the United States and operating in California, are subject to SB 253 and 261. And we've kind of, I think at this point, started to see and started to kind of learn and understand some best practices around how you start to prepare for this. So I think, like most, reporting obligations, particularly newer reporting obligations, 261 and 253 are the kind of this combination of like data meets compliance challenge. And I think as Matthias was saying, there's probably sort of two paradigms that you're coming from. So you're either coming from an organization that has like an existing sustainability program. You've probably already been measuring your emissions. You understand how to sort of calculate and report on scope 1 and 2. or potentially you're coming from kind of a leaner organization. You're newer to this, you maybe aren't doing emissions measurement, you haven't done a climate risk assessment, and California is kind of pulling you forward. Or again, maybe you're in the services ecosystem and you're supporting those types of organizations. I think the key things to obviously realize is that like California SB 261 and 253 do have significant data demands. You're not necessarily going to be penalized for not doing a particularly good job the first time around. And I think there is maybe a lower bar in kind of these initial reporting years. But I think there's also some important things to understand. One, whatever you report is going into the public domain, which means organizations and stakeholders will be able to look at it and they'll be able to compare it with other organizations who are reporting. So if some organizations have really kind of robust statements, really good data, and you're just sort of putting something out just to put it out, that may not look super favorably on your brand or on your sustainability practices or your corporate reputation. Similarly, there are kind of ratcheting up limited or reasonable kind of assurance requirements around emissions data. So initially, organizations don't really need to assure their data, but in future years, you're going to start needing to work with third parties and sort of verifiers to, again, provide kind of limited or reasonable assurance around the accuracy and the quality of your data. So if anything, this is kind of a test or a practice round where maybe the stakes are a little bit lower, but organizations are really going to want to develop these like controls, these processes, and this reporting because this is going to be an ongoing, sort of annual or biannual discipline. I think the second piece is also that there's like a lot of stakeholder collaboration. And in some cases, like some of the California conversations are like creating the first requirements for collaboration inside an organization between maybe departments that don't necessarily speak to each other or collaborate quite as often. So, if you already have like cross-functional committees or steering groups or working groups, that's fantastic. But California may be the case where kind of sustainability is working with legal or procurement or operations for the first time, or in newer ways that, again, the organization isn't necessarily used to. That can be a great opportunity, but it can also be a little kind of challenging and new and scary. But I think most important is that, if you are a sustainability practitioner or leader or consultant, going through this kind of internal education process, really setting expectation, communicating proactively with your colleagues. That's super, super important because you really want that type of alignment, and you likely are going to need support from other departments in order to complete this and get everything reviewed and communicated in an effective manner. And then finally, like there are very real deadlines here. So, for SB 261, for example, like your report is expected, January 2026. So basically, you have about 3 months to create this report and get it ready and get it reviewed. In our experience, it takes about 3 months to do this. So, you can obviously do the kind of, cram for the test or do your homework, the night before the exam approach. But generally, again, I think to run this by like corporate communications, run this by legal, make sure your analysis is good, make sure everything's been reviewed, you understand kind of what you want to say and potentially what you don't want to say. It's definitely a very good idea to start on this early. So essentially, if you're not working on this already or you haven't already started preparing, we would strongly recommend that you start preparing kind of right after this call, or at least kind of starting Monday next week. And I think ultimately, what we're trying to do, and I think what 1.5 is trying to do is really try to provide kind of efficient, cost-effective, and sort of agile support around this so that you can get something that's very adaptable, you can get something that's very auditable, or at least it will be auditable in the future, and that you have kind of the supporting expertise and resources to make all this happen. So obviously, like, we have existing software and tools that can provide a lot of value here. We can take a list of your corporate addresses, we can kind of run them through our analysis, we can look at zip code and county level climate risk data, and we can pretty much like deliver you in a couple minutes or, maybe an hour what the risk analysis or what your like physical risk exposure might be. Now, there may be other areas of climate risk, like policy risk or transition risk or sort of market risk that AI or our software can't necessarily automate for you. But I think we can do a lot of work very quickly that would take kind of manual or spreadsheet or sort of market research based preparation work a lot longer. As a result, we can often save a lot of money. So, working with a Brightest and automating this, running it through some of our algorithms and our tools can be a lot cheaper than paying a consultancy or paying an external partner. Often, sort of a quarter to 20% of the cost of kind of a manual or services based approach. And then finally, I think, again, because this is a compliance exercise, because you're going to be doing this year after year, you want to maintain these kind of auditable records. So you want a unified kind of centralized repository for your assumptions, your inputs, your methodologies, your historical reports that you can refer back to. It's really, really important to kind of get all that in like an organized center. So, what have we kind of learned so far working with clients, particularly around kind of SB 261 reporting and kind of getting this prepared? So, I think the good news is, again, a lot of the information that you need is readily available. So, whether you work with us or you work with someone else or you do this on your own, there are fairly good kind of data sets for climate risk that you can find. Some things are public source or readily available. The US government used to provide better data and unfortunately does not anymore for reasons not really worth getting into on this call. But I think, there are a lot of things that you can leverage in terms of doing this work. So, in terms of kind of concrete learnings and some of the things that we've learned from clients, again, I think tools like Brightest and technology and AI can automate some of the disclosure drafting, can automate some of the analysis, but we're not necessarily going to automate the full process. And I think, again, it's like internal stakeholder collaboration, internal dialogue, developing these processes inside your company, thinking about these different risk mitigation activities, right? Like, once you've done your risk analysis, did you actually identify any risks? If yes, what is the organization going to do about them? Your kind of final review, again, potentially finance or legal or accounting or other stakeholders should review this before it goes out. Again, probably corp comms or someone on the communication side. These are all the things that you kind of need to plan for. And I think there's team kind of collaboration, education, coordination, and communication. That's really kind of the key work. Like, again, we can automate a lot of the analysis, but the actual process itself is again very collaborative, and I think it's very kind of human centric when done well. So again, in our experience, this does typically take a couple months, right? You might want to spend 1 month on kind of data preparation, data collection, data assessment, thinking about materiality, identifying what your risks are. 1 month actually kind of developing and drafting the disclosures and then putting it again through kind of the proper review channels to make sure everything's finalized. I think kind of the third point that's important is that like, there's different ways to think about risk, and like gross risk or like your aggregate potential risk is not necessarily the same as your actual risk. And I think this is also really important in terms of like corporate narrative. So for example, like we've worked with certain clients where we've identified like a lot of risks on paper, but when we've kind of dug in deeper, when we've talked to specific departments, again, often going kind of beyond sustainability, we've actually found that in a lot of cases, maybe the sort of gross risks aren't really risks because there are, existing kind of resiliency measures in place, or the organization has a lot of, again, like insurance, if anything were happening, they have buffers, like there's different ways that the organization has kind of prepared itself for climate resilience that takes kind of a potential risk and deep, mitigates it. At the same time, though, there are also these like unexpected risks, right? Like, if we think about the wildfires that recently took place in California and like the LA region, like a lot of insurance and real estate exposed organizations in that region really were not prepared for those risks at all and really like weren't thinking about those types of risks in their risk calculus. So again, we kind of highly recommend like talking to finance, talking to enterprise risk, talking to different parts of the organization, understanding kind of what risks exist based on your business model, your supply chain or your value chain, where you're located, and then kind of understanding, okay, these are the possible risks or like the horizon of risks, but then what are our actual risks and what are we actually doing about them? And that's really like an important part of your narrative as well, because again, I would assume most organizations don't want to put out into the public domain, we did a climate risk analysis. Turns out we actually have a ton of risks that like are really significant to our business and we haven't done anything about them, right? Like that's not a very good public disclosure narrative. So I think the more proactive you can be around identifying the risks, but also understanding how the organization can control, adapt, and mitigate them, that's really, really important. And then again, like cross-team kind of consensus, education, governance is super important, right? You can get the best out of your partners, you can get the best out of your technology, but you can't like fully outsource this to a third party provider. Like we've had conversations where someone, has basically said like, "Hey, we'll just like give you our addresses, we'll give you our data. Can you just like put out a report?" And like, yes, technically we can, like we can kind of generate a report for you. But that's not really the point of this exercise, right? Like this is really about having these conversations internally, understanding kind of risks and opportunities, understanding what's material for the organization, and then thinking again, like how does the organization want to potentially change, right? If you're let's say a company that has a lot of like agricultural exposure, right? What is like severe or unpredictable or extreme weather doing with crop yields and with harvests, and how is that going to impact you or your supply chain or your suppliers? These are the types of things that like you can do this risk assessment, you can kind of understand where you are now, but it also provides kind of a compass and a way that the organization can really kind of look forward. So again, assuming we're kind of mostly talking to an audience that either hasn't prepared yet or is maybe a little late in their preparations, I think the first question is like, again, what do you have in terms of partner resources? Do you have a good tech system? Do you have budget for a tech system? Do you have consultants? Do you have budget for consultants? Do you have an intern? Like, what's kind of at your disposal and what can you leverage? Understand kind of what's available and then try to move on that as quickly as possible. Because again, you maybe only have like 3 months at this point. Like that may not be enough time to bring on a tech solution. Like if you are looking for support, we would love to speak to you. But again, there's kind of like procurement realities inside an organization, or maybe just the budget doesn't exist yet. Like these are the things you want to kind of understand as soon as possible. Again, I think like kind of mapping your inputs and like mapping your stakeholders. So, you obviously want to understand like your physical locations, where are your suppliers, like what's your exposure to climate risk in different jurisdictions. And while kind of SB 261 and 253 is focused on organizations doing business in California, the scope of the law is not just California. So you could be a European company or an Asian company. If you're large enough and you're doing business in California, this applies to you and it kind of applies to your global operations, or depending again on kind of the entity specific scope that applies to you, which again, you probably want to speak to like your accountants about. But I think it's really important to understand, what input data do you need? What's the scope or boundaries of your organization? Again, who do you need to work with in the organization? Like, do you need data from your supply chain team or your procurement colleagues? Like, do you need information from your EHS team if you don't work with them more directly? These are really, really important, and I think kind of make expectations really clear. And then, I think there's another kind of pragmatic reality, which is kind of understanding your organization's culture, your brand, kind of your mission and your DNA. And I guess maybe like leadership's kind of willingness to take risks or be a leader in this climate and kind of what you want to stand for. So there are definitely organizations that we talk to where it's really just like a compliance exercise. They kind of just want to check the box, get this over with. They don't want to do it poorly, but they want to do it like as good as everyone else. And then I think there's other organizations who again really see this as like an opportunity to have these sorts of strategic conversations to try to change the organization for the better, think about how to mitigate risks and think about how to kind of be a resilient and successful organization in an era of climate risk and severe weather. So, it's good to kind of understand again the maybe internal political environment that you're dealing with, as well, obviously taking into account the external political environment and understanding kind of how ambitious you want to be with this, relative to your peers and relative to other organizations. Again, California is kind of a global technology hub, and we obviously think there's really good use cases for technology, whether that's data collection, automation, just crunching numbers, using generative AI to draft or recommend disclosures, scenario modeling. There's lots of different ways that you can use technology throughout this process. If you're using Brightest, we have kind of the full California laws like already kind of templated out. So you can very easily kind of, again, spin up, save, and organize your reporting. But again, even if you're not using a Brightest, or even if you're kind of doing this more manually, there's lots of different resources and things available to you. So generally, again, just to kind of recap, I think it's really important to, assess like who are you as an organization? Where are you at? What's sort of the materiality and the applicability of this? What resources do you have? Who do you need to work with? If you need external resources, again, we would recommend kind of going out and finding those or locking them down as quickly as possible. Make sure you go through the process of like internal alignment and education. That's super, super important. Again, communicate why this is important to the organization, not just to sort of sustainability. Work through your data collection, try to automate as much as you can, prepare your disclosures, and then run them through the review and approval process, audit things, try to learn and look to improve over time, right? And again, because this is an ongoing thing, and because it also aligns with other potential future requirements or maybe requirements that exist in other countries or other jurisdictions, you want to kind of develop these like consistent, efficient, longer term processes and controls and metrics and mitigation strategies. So yeah, with that, thank you for your time. We're happy to kind of turn it over for questions. And the 1.5 team has also put together kind of a quick SB 261 readiness check. So if you want to scan this QR code, fill out some information, you can get a quick assessment of kind of your current readiness. And with that, yeah, thank you. Happy to turn it over to questions and back to Nina.
Wonderful, Chris. Thank you so much for the great presentation, and thank you, Matthias, as well. I think that hopefully for anyone who has joined, they have a much better understanding of what these regulations are, and they feel a bit more ready, perhaps. Even though obviously it's quite a short timeline, so if anyone has to report, yeah, as you said, Chris, they probably should start on Monday. So hopefully,
Good
no
luck.
one is.
I don't want to ruin anyone's weekend, but maybe start on Monday.
So yeah, thank you to you both. So indeed, we have a few questions from the chat, and anyone who has additional questions, please feel free to write them down in the chat, and we will try to cover as much as we can in the last 15 minutes of this webinar. So the first question is for you, Chris, which is, will you be addressing the use of global corporate reporting instead of California-specific reporting?
Yeah, it's a great question. So California, particularly with SB 261, is aligned to TCFD, which is Task Force for Climate-Related Financial Disclosures, which has now been kind of integrated into the ISSB, the International Sustainability Standards Board, which is put out by the IFRS. And then, for scope 1 and 2 and 3 disclosures, the assumption is that organizations are going to follow like a greenhouse gas protocol or another kind of credible emissions standard, like maybe ISO. So there's already kind of some like global or international alignment with the California requirements. I think, most of the other regimes that are looking at these types of disclosures, like for example, the CSRD in the European Union, or some of the like local standards like in the UK or Canada or Australia, most of them are kind of leveraging the ISSB, IFRS Foundation, and some of the other areas. So there is a fair bit of kind of interoperability between these different global standards. But I think generally, if you're an international organization, you should try to kind of meet the California requirements and understand the specific like reporting regime and disclosures there, but try to align it as closely as you can to any other again, local or kind of country specific or region specific reporting requirements that you have to do. There should already be a fairly high degree of kind of overlap or alignment between those things.
Thank you. Thank you so much for your answer, Chris. So then we have a question for Matthias, who already answered it partially in the chat. So the question was essentially about why are some companies not publishing their net zero targets, or how are they not sharing it publicly? So if you want to add anything to your answer, Matthias, feel free to share.
Yeah, I'm happy to. So let me just get the slide up that I was actually referencing here. So this is actually from an EY report in 2023. I think I said 2022 before, so apologies on that. What this is really showing is that there's this gap between reporting and setting your pledge, right? And so on 80%, on the left-hand side, it says that 80% of FTSE firms have made a public commitment. So they've pledged net zero, etc., right, for 2050 or whatever target they have. However, when you actually look into what they're reporting, the actual transition plan is not credible. And they have, a series of criteria to deem if it is credible, right? And this, I think, is what the question is relating to. There is what you're saying here is actually right. There is definitely a huge amount of value that you can generate from doing this correctly and putting together a credible transition plan. When you actually start to do things like measure your emissions, you're understanding your business better. You're understanding exactly what areas of your business have hotspots. For example, can you actually reduce your emissions around your energy, your building facilities, for example? These can be turned into decarbonization initiatives, which then turn into these annual cost savings, which you can then put back into your decarbonization planning. And that's using, this marginal abatement cost curve, but you can also use it for other things that require your cash flow as well, right? So these are incredibly immediate transition plans that you can enact, which benefit the organization as well. When you start to do things like your life cycle assessment or your product carbon footprint, so you're looking at, say, your products and services and understanding the hotspots of your value chain and how these products are created and the associated emissions with that too, you're also able to access the revenue side of the business, right? Where you can build these new versions of your products, like a low carbon alternative to that product as well. Now, this can mean that you can either take more market share, right, and increase your revenue, or you can change the margins that you have on your products, right, which addresses your costs. But you can also be more competitive with your products as well. And so there's some real connections to value here that ties to that previous slide that I did share as well, which highlights these opportunities on the right-hand side, if you remember, and how that links down into the core parts of your business model, your balance sheet, your P&L, as well as your cash flows, right? And so once you go down this path of building that credible transition plan, it starts to unlock those areas as well. So I'll stop sharing and pass it back to you, Nina.
Thank you for the wonderful explanation, Matthias. I think that now it should be clear in addition to explanation in the chat. So then we have a question for Chris. So for companies who are doing business both in California and the EU, are there any major differences in the reporting expectations?
Not particularly. So the sort of reporting is pretty standardized. So whether you are a US company and you're operating or doing business in California, or you're a European or international company doing business in California, the reporting requirements are exactly the same. So an EU company would report under SB 261 and under SB 253 exactly the same as like a US headquartered company. So as long as you meet kind of the definition that excuse me, CARB and the California Secretary of State have kind of laid out around doing business in California, then you are subject to this. And one thing I guess I will just call out really quickly, because we've had some clarification questions on this, and obviously I am not an attorney, so don't take this as the final word. But we have been asked by a few companies, like, we have a few remote employees who like live and work in California. Does that scope us into SB 261 or 253? And the answer, as we understand it from speaking to legal counsel, is no. If you have like a remote employee in California, but you're a European company, you're not necessarily in scope. But if you have like offices, if you're selling products in California, you have distribution centers, like if like California is actually a place where you're doing business, then you are in scope if you meet the revenue thresholds.
That's great to specify that, as I think that can be the case for a lot of people since we have a lot of remote workers worldwide. So thank you for specifying that as well, Chris. Then we have a question for Matthias, which is where does the client sentiment lie in practice, given that many who are late to prep could try or rely on specialized tech agencies to outsource this exercise to meet the deadline. So are they building or buying, and why?
Yeah, I think the worst answer to this is it depends, but that's the answer to this. It depends on the budgets, the type of industry they're in, the kind of margins they have, like what cash is available to pay for this, what resources do they have. I can't provide too much information on people that don't use our services and their experiences, but when we're looking at the I guess, landscape of sentiment around sustainability in general. As I mentioned earlier in the presentation, there is this consideration of sustainability and certainly compliance as a cost center, and I think that does play into how their sentiment is at the moment. Um, I think the other side to think about this is in practice. Maybe I can share like an interesting example from one client that we're working through on some of the California regulations. Chris had mentioned earlier that one of the benefits here is that you're bringing people together across the organization that would not normally work together in this type of context. When you're looking at climate risks and you're looking at climate scenario planning, the client that we're working with at the moment is actually really excited to do these tabletop exercises that they've done for cybersecurity breaches, natural disaster training, for example. And so they're inserting some of this climate risk scenario planning and risk management work into their existing processes. And also they're bringing in all these different new functions into that exercise too. And so I think once you get beyond that, okay, great, we do need to invest some money into getting this right, it then shifts into, well, actually, who do we need to get involved into this really important, critical business planning and risk management type of activity? And that's actually where the value comes when they start to get it and they go, okay, actually, this is really important. And it ties to how TCFD was created in the first place by who's now the Prime Minister of Canada, Mark Carney, and Michael Bloomberg as well. In 2015, when they released it, they worked with a lot of companies to understand how they would best want these standards coming through. And that's the backbone of this as well. So it does tie to direct benefit. And I think once you get through this barrier of, yes, there's some cost, and you then make your decision of, do we have resources? If yes, then we can do it ourselves based on that tight timeline. Or do we generally outsource these things and we have the budget to do so? So perhaps some color there for your answer there, Santi. Thanks for the question.
Thank you, Matthias. I think we have time for maybe one last question. I'm not sure if we'll have time to cover all of them, but thank you for everyone for asking all these questions and being engaged. So one question for you, Chris, is what role or value do you see in third-party verification for Scope 1 and 2 for SB 253? And this Dan is saying that he recognizes this as a practical run for many companies, but at some point this data will need to be audited and verified. So is there value in going through verification now before it becomes a requirement?
Yeah, it's a good question. I think there's, again, kind of a different ways to potentially think about it. So, going through verification or audit or limited assurance, like typically has costs associated with it. So I think that's sort of the first thing is like sometimes organizations don't necessarily want to go through audit or assurance just because they don't necessarily want to pay for it. So I think there's like a financial or kind of a budget reality there. But beyond that, generally, the sooner you can move to something which has kind of third party independent review or assurance or verification, likely the better. And I think an analogy that we've seen a little bit is CSRD, which is the European Corporate Sustainability Reporting Directive. So basically, I think as some people may know or may not know, like CSRD was originally supposed to kind of take effect already, or there were a lot of companies that were in scoped for CSRD reporting in 2025. And then in January, there was like an omnibus regulation, and the reporting deadlines have been pushed back by 2 years, and some smaller companies have been scoped out. But essentially, what we were kind of doing and what we had kind of worked with various clients on was saying, okay, 2024 is going to be like the test year, and then 2025 is going to be your actual first reporting year. So let's actually try to pass like assurance or verification in 2024, knowing that maybe we're not going to, or we're going to uncover some issues, or we're going to cover some errors. And then that's going to give us the time to actually like implement those fixes and controls and improvements the year that it actually happens. Now, again, understanding that like California is taking effect very soon, you probably maybe again don't necessarily have like years and years of practice to build up in terms of runway. But you do at least have kind of one practice year where the bar is relatively low. So it likely is good to try again, assuming you have kind of the financial resources to do some sort of limited assurance or third party verification. Maybe it's something lighter. Maybe again, you work with kind of a smaller, like independent consultancy. You don't go to the big four essentially and try to do this. But again, that's really kind of up to you in terms of your business size and your resources and your budget. But I think the sooner you can kind of move beyond like spreadsheets and back of the napkin math and things that are hard to verify, and the more you can make this like a precise, auditable, supported by evidence and documentation process, that'll serve you well, again, not only for California, but for any other sustainability reporting that you're doing.
Absolutely, and thank you for your answer, Chris. I think there's definitely a lot of value in it, and that's what we see also with our clients, right? Who are very often asking us about auditability. It's one of their favorite topic. Fantastic. So we are exactly on time. Thank you both for joining, and thank you to everyone who was actively asking questions and engaging. So thank you for your attendance, and I hope this was helpful. And of course, if you have any additional question, feel free to also send a LinkedIn message to Matthias, to Chris, or to myself, and we'll be happy to answer any of those additional questions.
Yeah, maybe Chris and Nina, you can drop in your LinkedIn's in the chat as well, if helpful.
Yeah, let me do that.
Yeah, amazing. Great. And then if anyone hasn't gone through the SB261 QR code, I'll just flash that up quickly as well, just for the end. One last snapshot.
Thank you, everyone.
All right. Thank you so much, everybody.
Thanks,
Have
everyone.
A great rest of the day. Happy reporting.
Yeah.
Happy
Good luck,
reporting.
everyone. Bye.
Good
Bye-bye.
luck. Take the weekend off.
Bye.
Start Monday.
Yeah.
Bye, everybody.
Bye-bye.
Bye.